Welcome back everyone to the Audacious Money Witch channel, where we talk about the magic behind the stock market. Carvana is one of the greatest turnaround stories in corporate America. I can't think of one that has been more astonishing. The stock returned to shareholders 4,000% profit from 2 years ago. If you put $25,000 in this stock 2 years ago, when it was a penny stock, like $4 per share, today you would have become a millionaire.
CVNA, Carvana. Where do you see the
No, it's
stock
like an
going?
option. It's an option. It's too hard for me. I think you can go up, a point and down 3. We're looking for high-quality situations.
Can this opportunity happen again for us? Right now, the stock is around $200 a share, but we have a weak car market, and we also have a short seller. Hindenburg Research just disclosed a bet against Carvana, claiming the online used car retailer's recent turnaround is a mirage propped up by an unstable loans and accounting manipulation. I have been in the market for over a decade. It is worth reviewing how I have done last year. Last year I did pretty well, up above 56% just in the past 3 months. I had multiple home runs, Coinbase, Honest, and Tesla. But my True Leaf stock was the one that unfortunately dragged down the performance because Florida's vote didn't pass for recreation. This year is a completely different story.
Whether we get that unbelievable Carvana opportunity remains to be seen. In this video, I will talk about my own research about Carvana and Hindenburg's short report. Is this a potential buying opportunity? Let's jump right in.
You are watching Audacious Money Witch channel. If you haven't heard about Carvana, don't worry, let me bring you up to speed in under 30 seconds. Carvana is an online used car dealership which accounts for 70% of its total revenue. Their entire shtick is that they have car vending machines. Carvana prides itself on a simple, seamless, and differentiated used car buying experience where customers can purchase cars online rather than in the dealership showrooms. The company's platform has been described as the Amazon of cars. For real, Carvana is simply a used car dealership marketing themselves as a tech company while also marking themselves as a car vending machine. The absolutely massive red flag associated with Carvana is how they actually make most of their money, which actually doesn't come from the sale of vehicles.
Huh. How long have you been tracking our car's value with Carvana?
Just like 7 months.
Should we sell it?
We hold.
Hold.
Silver vans are going for more right now. Should we?
Our low mileage is paying off. You think we should?
Hold.
Depreciation's really heating up. You think? We just did 2.5%.
Now!
I'm on it.
Already sold to Carvana.
Instead, it comes from the financing of the vehicles. Carvana relies on finance and insurance. The idea of using loans and financing as major revenue stream for a dealership that isn't the problem here. In fact, that's pretty standard practice in the world of dealers. Financing is a huge revenue stream, but the problem with Carvana specifically is the types of loans that they're giving out and the way in which they finance their cars, as well as how they classify these loans on their financial statements. Now, Carvana makes a lot of their money off of financing vehicles for buyers, but the bulk of their loans that they offer to borrowers are in the form of securitized subprime auto loans. Now, if the term securitized subprime loan sounds familiar to you, there is a good reason for that. And that is because of the fact subprime loans are a big reason as to why the economy collapsed in 2008.
The report called Carvana a father-son accounting grift for the ages, centered on Carvana's practice of loan sales as well as the business relationship between CEO Ernie Garcia and his father, Ernest Garcia II, who is Carvana's largest shareholder. Carvana called Hindenburg's report intentionally misleading and inaccurate without going into specific details.
Short seller aside, the stock is traded ridiculously rich. Carvana trades at an 845% higher sales multiple than online car peers like CarMax and AutoNation, and a 754% premium on a forward earnings basis. These extremely optimistic valuation multiples appear to factor in a high probability of continued growth that will result in vast runway profitability. Carvana's valuation also seems to take for granted that the company can overcome its current debt burden. Carvana has the lowest credit rating among its peers at B-, meaning junk, according to Bloomberg. The company remains significantly indebted, with net debt currently at $4.8 billion.
Carvana's business is hugely cyclical and faces major headwinds. Subprime auto loan delinquencies are higher than during the 2008 global financial crisis. Today, used vehicles prices have declined 20.3% in the past 3 years.
Carvana has very few restrictions on lending, merely requiring that a loan applicant have annual income of $5,100, be over 18 years old, and have no active bankruptcies. Target the distressed consumer with a lower priced vehicle that's not quite up to adequate standards of quality, and make it an easy process. We actually approved 100% of the applicants, said former Carvana director. Describing virtually non-existent underwriting standards, Carvana's website states that 99% of applications are approved within just 2 minutes. These are loans given with poor terms to less than great borrowers who are typically unqualified for the loan that they're getting. Subprime loans are riskier to the lender because of the fact that they're going to somebody with either bad credit or poor credit, or somebody that may be on the fence of qualifying for that car at all.
Carvana makes it look so easy, but really it just became this insane, extremely awful nightmare.
During the pandemic, Alicia Evans flew all the way from Sioux Falls, South Dakota to Phoenix, Arizona to buy this Mazda sedan from one of Carvana's futuristic vending machines.
Oh my God, it was like the most exciting thing to happen to me.
But she says all that excitement quickly wore off.
They made it so fun, but then all of a sudden, a month after, it was like a nightmare.
First, she says there were mechanical problems.
The shocks were bad, and then the tires had to be replaced after a month.
Then the temporary tags Carvana provided expired, and she says she was unable to register her car. A big problem since she worked as an Uber driver.
And they just told me that they were not responsible.
She says she was unable to drive for Uber and lost her job. She's now homeless and living out of this old beat-up RV.
As a result of this higher risk borrower, they oftentimes have to pay an insanely high interest rate. In the case of Carvana, sometimes these interest rates are as high as 20%.
20% for an auto loan? That's like a credit card level interest rate. The appeal of a subprime loan from a lender's perspective is the fact that a prime loan, which is somebody with a qualified credit history, though they are the safest investment for a lender, they are also the least profitable. On the flip side, a subprime borrower is a high profit but also high risk borrower. You're paying an insanely high interest, and thus you're making a lot of money off of it. But the risk of that borrower not paying back the loan at all, and thus you have to repo the car, that's definitely a risk you're going to have to take.
Carvana relies on third-party financiers to purchase the auto loans it originates over the last 9 months. Carvana sold $6.15 billion in loans for a gain of $541 million, a metric representing 2.2 times net income in the period. It's actually more of a subprime finance business than it is a car dealership. said by a former Carvana director. I don't think the model is much different than what we saw with kind of the 2008 mortgage-backed securities. Like if people are under 18, you can't give them loan no matter what. Various other stuff like that. We actually approved 100% of applicants we didn't decline for compliance reasons. And the way we manage risk was through down payment compared to banks. I think it's probably substantially more risk tolerant.
Oh, our car's value went up.
Maybe we should track all our cars' value on Carvana.
All of them?
All of them. We need more trackers.
I'll track the van.
Gotcha. Is that my belt?
Parts of it, yeah. Ooh, I'm getting a value update. Do you see which one is going off?
How's it tracking?
Good, got some dips, some rises. Now what, hold?
Sold. Did we get a little carried away?
Hindenburg also alleges that an increase in borrower extensions at Carvana is being enabled by the company's loan servicer, an affiliate of private car dealership DriveTime, which is run by Garcia II. The company seems to be avoiding reporting higher delinquencies by granting loan extensions. Instead, this is not the first time the Garcia family and its control of the company have been a target of some investors, including lawsuits in recent years alleging the Garcias run a pump and dump scheme to enrich themselves.
Carvana went public through a SPAC in 2017 after spinning off DriveTime. DriveTime was formerly a bankrupt rental car business.
Most notably, Carvana still relies on the company for servicing and collections on automotive vehicle financing, and the two companies share revenue generated by the loans. The businesses also, at times, sell vehicles to each other. And Carvana leases several facilities from DriveTime in addition to profit-sharing agreements. The stock plunged from $357 on Ernest Garcia II last sale in August 2021 to a low of $3.55 in December 2022, representing a 99% decline. The thing I don't like about this company is the book value. It used to be negative, which means if the company files for bankruptcy, shareholders get nothing. They get zero. The debt to equity ratio is terrifying to say the least. Would you jump on it if this $200 stock goes back to a $3 stock in the future? Let me know. I would be interested to start buying if it drops to $5. This could be an epic fall. Let's watch it fall.